Hello and welcome. This is the Mutiny Investing Podcast. This podcast features long-form conversations on topics relating to investing, markets, risk, volatility, and complex systems. In this episode, I'm joined by Mutinyfund CIO Jason Buck and our close partner at RCM Alternatives, Jeff Malec. We discussed what we saw in markets in Q1 and how various volatility strategies performed and reacted to the events. To give a bit of context, Q1 2021 that we'll be talking about saw the S&P up about 6%, the VIX was down about 14.8%. That was fairly range-bound over that period, and the PutWrite index, which is a rough proxy for at-the-money volatility on the S&P, was up about 5.82%. So that's people selling options at the money. Accredited investors that want to learn more can contact us at info@mutinyfund.com for more information, or you can submit an inquiry on our site, mutinyfund.com. So without any further ado, I hope you enjoy this conversation.
Jason, what are your big takeaways from Q1?
So Q1 in general saw S&P still going ripping higher. We saw, up 6% over Q1. Vol still kind of, crushing back down. I think at one point we were up in the 30s. It came back down for the first time in the teens. This is the first time we've seen the teens since the pre-COVID era. But inside of that, there's always a lot of noise inside of those numbers. So Jeff, what was your, individual takeaways?
Yeah, I think the big takeaway for me, if I had to label Q1, would just be a return to normal. To more normal. But I think inside of that normalness was still a lot of craziness that if we'd been in 17 or 18 would have been kind of big market moving, altering events. You had GameStop, Melvin Capital, a couple other hedge funds on the ropes in January. Then you had I'm going to butcher the Greek name, but Archipagos or whatever it was, Bill Hwang's family office. And him going from 200 million net worth to 10 billion to zero over the course of a few weeks. Right. So those kind of things, even in 07, 08, you saw, the first Bear Stearns hedge fund that went bust because of their mortgage-backed exposure. Those kind of stories felt like that, right? They felt like kind of canaries in the coal mine. But at the same time, vol was just getting crushed throughout that period and market was going on to new highs. So do I look at it as there's this insane ability to handle those events, or are those still kind of canaries in the coal mines and there's a lot of fragility under the surface?
Right. We only see those things really in hindsight, right? Like there's all these canaries in the coal mines on the way to a top, and we're not necessarily calling a top. That's not what we do in general. But it's interesting that the Archipagos blow up and seeing it cascade of billions of dollars in losses across investment banks, which is going to have them, reducing leverage across all different kinds of strategies that had nothing to do with what Archipagos was doing. If that had happened, pre-2020, we would have thought that would have had a cascade effects that spiked volatility. But once again, it's like when we saw the storming of the Capitol and volatility stayed unchanged. These are kind of unusual times that we've been living in, especially that echo of volatility that we constantly talk about since March 2020. But that's generally the markets we've seen, and whether GameStop was a nice blip in volatility as people got a little nervous around the GameStop, but then it subsequently came back down rather quickly. Taylor, what kind of jumped out at you over the Q1 period?
So I was going to say, let's drill in, maybe kind of go month by month and look at it more detail. I think, right. So kind of GameStop, Wall Street bets saw that mostly play out these had kicked off in January. And it's still kind of been ongoing, right? But basically a bunch of people on Reddit decided to pump the stock of GameStop, which went from $2 to $200 or something. And there were a bunch of hedge funds that were shorted. And so we saw this big, I think part of the story there was this expansion of implied volatility that didn't really show up in realized volatility. We talked about that some last year, that sort of typically implied volatility, which is reflected in options prices. So, effectively how much people are willing to pay to kind of insure their portfolios against volatility versus realized volatility, which is, what the market is actually doing. Typically, those tend to track each other fairly closely. But we saw again, sort of in January, something we'd seen kind of Q4 2020, which was realized volatility stayed pretty low. And implied volatility kind of spiked up. I guess you said, maybe people looked at it and they saw this is something that would have been a big deal in 2017, 2018. But
yeah, I think
turned into a nothing burger.
Yeah, sorry, I cut you off right before your famous nothing burger line. But I think there's a slight nuance there, right? Of like in Q4, you had implied was kind of pegged, right? It was staying at the same level. People had this worry around the election, around the storming of the Capitol, all this stuff, but it wasn't really increasing. After that, the beginning of Jan, we saw all realized and implied start to come down. Then the GameStop Melvin Capital implied kind of spiked a little. People, this canary in the coal mine factor, they said, hey, this is, here's a hedge fund getting taken out. Some big rescues having to happen. That's a signal, and let's, bid up some option vols to protect ourselves later on. But as you said, Taylor realized didn't really do it. So yeah, there was all this talk, there was all this worry, but outside of GameStop, going up 4,000%, down 1,000%, round tripping all over the place there wasn't really the realized vol inside of the S&P especially.
Yeah, it's good to point out that, you have that volatility in GameStop, but it's such a tiny equity that we're primarily focused on the S&P 500 and major sell-offs in the S&P 500. So you're not going to see that really affect our portfolio much at all. I mean, we do have managers that trade dispersion strategies as part of their overall programs. With dispersion, you can be, short index vol and long single name stock vol, but you would assume they'd have to be in the GameStop trade, but also it's just going to be one of many trades. So at the end of the day, even if they were in GameStop, it's really not going to affect the overall portfolio of the long volatility series. And like we said, we're primarily concerned with those major sell-offs in the S&P 500 index.
Yeah, and just to that, further on that point, right? If we saw one of the managers had a big position or even a modest position in GameStop, we'd be like, what the hell are you doing? That's not what we signed up for. Right, it's a dispersion trade. It's just to say, hey, there's going to be more upside volatility in these single names than there is in the index, and to capture that as a whole, not betting on some single semi-bankrupt stock going up thousands of percent.
And then February was, I guess, sort of a fairly ho-hum month. I think the S&P was up around 2%. Vol drifting kind of lower. It was. That's the kind of environment where sure the dynamic VIX strategies we would hope would perform well, and they did do sort of okay in that period from what we saw. They were able to capture some of that that volatility erosion. So that dynamic VIX strategy is a relative value trade using could be VIX futures. Typically VIX futures that's looking at where sort of along that curve they think there's relative value. They can go long part of the curve, short part of the curve. And so they can do well in sort of trending up volatility or trending down volatility environments. So February, those strategies seem to do okay. We also saw February 25th, for example, there were some pretty strong intraday trends. So when you have the market close on its lows, the sort of those short future strategies, which are doing that sort of intraday trend following, can do well. We saw some of that, and then I think options, after the implied volatility spiked up a little bit in January, it came back down pretty hard in February, which was challenging for the option strategies.
Yeah, I guess I'd say, this overall concept of a return to normalcy, really, if you dig into the month by month, it really was more in February and March than the whole quarter. But as you said, February and March was more, hey, the market's rallying, consistent rallying higher, volatility's falling at a normal measured pace. And as you said, those dynamic VIX managers, they kind of like that a steady relationship, right? So no matter if vol is falling or rising, as long as it's not falling way faster in the front month than the back months or vice versa, or as long as implied's not falling way slower than realized or vice versa, those, when there's volatility inside of those measures of volatility, not to get too complex, but they want that nice relationship to stay rather stable day to day, week to week, in order to for their models to work in that dynamic VIX space.
And as I think about January and February in general, is kind of the way we built the portfolio for long volatility series, is that we want a distribution of returns coming from the different buckets we invest in. So hopefully certain parts of the strategy will ballast other parts while we're just trying to maintain our exposure for the massive sell-off. So in January, like we said, we saw, that the two parts to our options buckets were up and VIX arbitrage and the short futures were down. And then we saw the exact opposite in February. And I think that speaks volumes to the ensemble approach of trying to maintain a level exposure while waiting for a massive sell-off to happen.
Got it. And I think net, the idea, right, is to outperform just a simple put buying strategy or something like that, where you can't necessarily capture those different path dependencies week to week, month to month. And then Taylor, you did mention something else, and I think that was a pattern. Hopefully, we'll see more of February and March, that intraday moves seem to hold a little bit better. We seem to see them close a little closer to their lows or to their highs. I think that's a result of volatility coming down, or probably more technically, the VIX coming down below 20 is more of a result of not flip-flopping throughout the day. So throughout last year with vol high, we saw, the market's down. I'll just talk in S&P or Dow terms, right? If it's down 3-4% and closes the day only down 1% or closes the day higher, those are the kind of days that really hurt those day trading models. So the more we see in the future of a down day finishes the day down will be helpful. And
I don't think there's not a lot more to talk about March specifically, unless you want to chip in, but kind of, as you said, just a continuation of February. In a lot of ways, saw volatility continue to kind of decline. And I guess really maybe it crushed in a little bit more in March than it did in February. And then the stocks rallied a little bit more aggressively. I think the S&P was up 4-ish% for the month.
Yeah, I mean, the big surprise to me there again was this Archegos stuff. Jason, how do I say it?
I like somebody else pronounce it as arch egos. So it's really Bill's just ego. So
right.
Instead of Archegos, you could just say arch egos.
Arch egos, right? But I mean, the numbers are still coming out. I was seeing Credit Suisse like billions, $5.5 billion or something, $7 billion. So there's billions of dollars here, and it was just sort of a blip on the radar as markets crunched higher. So to me, that was the March story of like, how was that such a nothing burger, as you said?
That's Taylor's favorite nothing burger. But I think, it's one of those things you don't know in hindsight of like, how did we not see the cracks in the pavement if, hedge funds are blowing up and investment banks are losing, billions across a wide swath of investment banks. So we won't know it except for in hindsight. I also think about in general, as we're seeing VIX or volatility get back in the teens, like you're saying, this return to normalcy or normalistan, that bodes well, hopefully, for our long volatility series in the future. As we get to these pre-pandemic levels, it allows our managers. I think Taylor wrote very well about this over the Q1 period. That it allows us to kind of rebalance and also reboot and reload on a lot of our convexity and the different strategies. And then that also bodes well for the 100, the long volatility series plus stocks, because now, as S&P is still tending to rip higher from here, where the long volatility series is maintaining at a lower volatility point, that helps that correlation between those two and that rebalancing effect moving forward.
For sure. And that, to me, you saw that again in Q1, like that's just the power of that long volatility and stocks is the ability, even, and I'm talking with clients and they're like, oh, I'm starting to get scared of equities here. Right. And it just brings in that emotion and that fear and, okay, I'm going to reduce my exposure to only 60% or some arbitrary number. Like, how do you actually make those decisions is very tough. And so to me, that's the beauty of that series of just basically, you don't have to make those decisions. You can keep that exposure with the protection.
I think that's a good, one of the things we talk about internally, right, is covering different path dependencies, right? We're moving into an uncertain future and there's many paths that can be realized. So last summer, I think there was all this, it was an interesting way, the word path dependency wasn't used, but people referred to it, right? But we talked about a V-shaped recovery or a W-shaped recovery or an L-shaped recovery or I think inverted cosine recovery was one of them, right? Inverted square root recovery.
Nike swoosh recovery.
Swoosh recovery. Right? But I think that's, it is kind of an intuitive thing, because basically what those letters, the shapes those letters are talking about is various different types of path dependency, right? So, in a W-shaped recovery, that was people saying like, well, this is a bear market rally and we're going to have another big sell-off. And people like to make the Great Depression analogy, like 1932, there's another big sell-off, and things are going to go back down, or it's going to be an L-shaped recovery, and the S&P is going to recover, but very, very slowly, or V-shaped recovery, where things are going to recover more quickly. And so I think we got something closer to a V-shaped recovery. The S&P recovered pretty aggressively over the past 12 months, making new highs. But in terms of how we sort of think about the portfolio construction is, we wanted sort of the portfolio to do well across all those different paths, right? It's not just, we couldn't predict which of those shapes or some other shape the recovery was going to take. And so, part of that is you don't necessarily know which piece of the portfolio is going to do well. So, in the case of a long volatility and stock strategy, that the stocks obviously were the component that did really well. But as Jeff was saying, right, that long volatility component was there in the case that, maybe it was a W-shaped recovery. Maybe there was, a big second leg down. I don't know, maybe there still is another second leg down to come. I don't think we have any idea. I think the presidential election last year, for sure, I think was a lot of concern around that. And that turned into another nothing burger, as it was. But
I think the issue is, right, forget the recovery. Like, who cares what shape the recovery is? But what if it's the Zorro non-recovery, right? Like, if there's a huge sharp Z down to another, what were we down 30%? If we went down another 30%, and we were back at kind of 08, down 75% in the NASDAQ kind of levels, that's like generationally wealth killing stuff there. So that's what we're, Mutiny's dedicated to protecting that kind of a loss. And as you said, the gravy is helping to manage that, whatever shape of that upside recovery looks like.
Well, I think part of that, what you're alluding to, is that's what the long volatility series is there for. And obviously, nobody likes drawdowns. We don't like drawdowns. We have our own money, our family money, our in-laws' money in the fund. So we don't like drawdowns. But proper portfolio diversification is having some structurally negatively correlated assets. So sometimes you might have something losing while another's gaining, but it's about what does that look like holistically. So they were talking about the different shapes of potential drawdowns or second or third leg downs. The other flip side of that is Taylor referenced the 1930s. In 32 and 33, you had markets rip up 70% and 32 plus, and above 80% and 33 after massive drawdowns. So once again, it's a holistic construction. If you can hold both that equity beta and that long volatility and tail risk and rebalance frequently, that allows you to ride any of those market environments, not just the ones on the way down, but as we've seen this S&P ripping up higher. And granted, the drag doesn't feel good. But that's general portfolio construction. That's how you build a holistic portfolio that can maintain through any macroeconomic environment.
And I just jarred my memory, actually, a little off topic from what we were just talking about, but my final comment on the Q1 was the gold and bonds really got smoked. So some of our managers look to use those as proxies if index volatility is overpriced or a little too expensive to hold, which was the case in January, less the case in February, less the case in March. But in general, that was a drag on the overall portfolio of those two markets, seeing some of their worst quarterly performance in over 50 years. Wayne Himmelstein in his March newsletter pointed those stats out.
Yeah, part of that was this idea in Q1. We had this new part of our nomenclature is everybody's got to be aware of the reflation trade now. But the question then is is it transitory, or is this a new inflation environment we're about to be in? And nobody knows that for certain, especially coming out of, post-lockdown pandemic, at least in the United States. Well, other parts of the world are still on lockdown. So we'll see, what the future kind of looks like. I think a lot of people keep referencing the roaring 20s, but they forget that post-Spanish flu, there was a 2 to 3 year recession before we had the roaring 20s. Now, we're not that keen on historical precedents as we don't think it maps perfectly, but I just think it's interesting to point out that people forget that dip before the roaring 20s. So, and then coming out of a an unprecedented global pandemic environment like this in the modern digital age, none of us know quite what it's going to look like, which once again behooves us to have much more holistic portfolio construction that can handle, multiple environments.
And it's interesting you say that, right? Because people are kind of holding these two separate thoughts in their head of like, oh, it's reflation, we're going into the new roaring 20s. But then you also hear all this stuff, the pandemic condensed 10 years of growth into 1 year.
Yeah.
Right. But they never equate that to the market. Right. What if it equated if it condensed 10 years of the roaring 20s into 1 year? And that was the year we just came through. So I feel like they're trying to say, here's all this growth. It's been condensed. It's been accelerated into the now. But I could argue, well, haven't we seen that in the market? Right. That's why the market's gone where it's gone.
I think that's an excellent point. Like, people have said that there's been dislocation between the market and the real economy, but as a lot of people would say, the market's a forward projecting, market. So that's a great point. What if we just condense the next 10 years into the last, year and a half?
Great. Well, any other thoughts on Q1? Or I think that sums it up. Yeah,
I just want to point out some things on the operations side. We had both Headwaters Volatility and Pearl, both ended up closing down shop. That run by Matt Rao and Tim Jacobson. And we wish both of them and everybody that worked at those firms all the best in all their future endeavors. And at the same time, we've added Ambrus Group with primarily, the forefront is Chris Sidiel there and William Wise. And then we've also added the guys at Breakout Funds as well. And so we look at Ambrus as part of our volatility arbitrage bucket. Where they're using, much more opportunistic trades, a lot of dispersion trades to try to, capture some of those volatility moves. But also they combine both yield and convexity. So we think it fits nicely into our volatility arbitrage. So we're happy to have Chris and Ambrus on board. And then the breakout funds, we look at them more as, as a global macro way to trade futures, which goes into our futures bucket. And the idea being that, some of these global macro trades are basically kind of long options trades. As you put on trades and all the different global macro instruments, and you're waiting for those to play out over weeks, months, or quarters, it's a form of long optionality, even though they're using the futures markets and using a different way of algorithmically looking at those futures trades. But we highly recommend that people check them out on our podcast so you can learn more about both Ambrus and Breakout and how we added them in Q1 and how we look at them fitting into our overall portfolio.
And then I think it's worth noting, we mentioned back in Jan and March these what previously might have been market blow-up events or kind of the catalyst that caused a sell-off. Nothing happened. I think people like Chris Sidiel and Jem Carson would say, well, that's because Gary or the market makers had pegged the market at a certain level because that's where all their exposure was, and they weren't going to let the market go below that. So just to say, those pieces are covering yet another path dependency of, okay, what if all this other stuff happens, but if the market dynamics and market structure and flow of options and delta hedging doesn't allow the market to go below certain levels, that's what those guys are now in there for, and they're playing in that game, so to speak.
And to briefly, Gary is a term that I think Jem Carson coined, or I've seen him use it the most, but it's a personification of option market makers as some individual named Gary, right? So the kind of thesis there that some people think about is, you have these option market makers and they're selling options and they're having to hedge their positions, and that is having a bigger impact on the market. So if you have certain market microstructure things with the option market makers, that they can basically act either as very strong support for the market, that they're buying dips and selling rallies that's keeping volatility low, or things can tip the other way and they can end up being driving the market further out, that they're selling declines and buying increases. So that's another there's some effect there. That's some part of the dynamic, but how much is it? How big of an impact is it having? Still an open question. So we'll see.
Yeah. And I always find it helpful. Market makers seems nebulous and mysterious a lot of times, but really we're talking about Citadel and groups like Citadel, right? Who are selling all the options to all the Robinhood traders that are buying them essentially. And then they have to hedge that exposure. If that market rallies through and they have to pay out on those options, they need to be making money on the way up. So they buy those stocks on the way up.
Let's just name some others though, like instead of just like Peak Six, Wolverine, Jane Street, etc. Those kind of Susquehanna, those kind of market makers. And to Taylor's point, what we like about what these guys are doing is being very cognizant of building their algorithms around trading volatility, watching the volatility surface, but then more importantly, looking at the different players in the space and how you can create sometimes pinning effects around certain inflection points. So being cognizant of those pinning effects might keep vol suppressed, but then if we move beyond there, it can accelerate into a long volatility environment. So they're very cognizant on the short vol side of pinning effects of market makers while maintaining a long volatility position, because in case we break through a 2 sigma event, you could see a massive acceleration as well.
And there's very interested. There's a Twitter account, I believe it's Squeeze Metrics. The guy's avatar is a lemon, but he put out a white paper, I think sometime last year. He came up with sort of a way of measuring this he called the GEX, but basically looking at doing an estimate of what's the sort of net overall positioning of options market makers. And, again, sort of an imperfect proxy that may or may not be useful, but I think he talked through the dynamic in a pretty well explained way. So we can link to that, or you can find him on Twitter and see the paper.
Yeah, you have the GEX with Squeeze Metrics. You have Lily's NOPE index, but then also all of our managers create their own models of this, and then they're also getting all of that institutional dialogue from the traders they're trading against to get some ideas of where all that is. So everybody's kind of has to create their own, and it gives them a bit of insight, but it's never a perfect simulacrum of how the market's going to move into the future. Otherwise, these guys would own islands. So
yeah, exactly.
Great. Well, that'll wrap up Q1, and thank you all very much. Thanks for listening. If you enjoyed today's show, we'd appreciate if you would share this show with friends and leave us a review on iTunes, as it helps more listeners find the show and join our amazing community. To those of you who already shared or left a review, thank you very sincerely. It does mean a lot to us. If you'd like more information about Mutinyfund, you can go to mutinyfund.com. For any thoughts on how we can improve the show or questions about anything we've talked about here on the podcast today, drop us a message via email. I'm Taylor@mutinyfund.com and Jason is Jason@mutinyfund.com, or you can reach us on Twitter. I'm at Taylor Pearson ME and Jason is at Jason Mutiny. To hear about new episodes or get our monthly newsletter with reading recommendations, sign up at mutinyfund.com/newsletter.